here's a chart. The blue line is the Fed's balance sheet, that reduction that we had in the balance sheet during QT. Now you see that one little blip up. That was the Silicon Valley Bank crisis, but that's the reduction so far. And again, just slightly below $7 trillion on the balance sheet. Bank reserves, you can see below that, have also been tightening along with the balance sheet. So again, that's where that stress is starting to show up. And the last time we were kind of at these levels in terms of kind of the bank reserve balances was back in 2015, 2016. And that was where we're getting to the Eurozone crisis and Brexit and kind of all that was going on. So again, that gap in funding is potentially a problem. Now, the markets haven't minded much of this at all. Again, previous to 2020, there was a decently high correlation between the markets and Fed liquidity. Fed liquidity was being loaned out by the banks into the markets. And even though this reduction in QT was reducing a lot of that liquidity, markets have just exploded over the course of the last 3 years in particular because of all the money that we inject into the system. And that's all now wound up back in the markets. Again, none of this is a surprise. That does kind of bring us to today's topic, which is talking about the investor dilemma. Because of all of this liquidity that was injected into the system has created kind of the Pavlovian effect for investors. If you go back to classical conditioning, Pavlov did this experiment. When he would ring a bell, the dogs would get food. So he was applying this trigger to the dogs. And eventually he could ring the bell and the dogs would just start to salivate even though he didn't give them food. Because they were conditioned that every time they heard the bell that a food was coming. And so there was this response that occurred because of this. And the same thing has really happened to the markets over the last 15 years following the financial crisis. Steve Sosnick of Interactive Brokers wrote, the other morning someone asked me why we were trading higher. I made a flippant comment. They rang the opening bell. That's why. Taking that a step further, on a morning when stocks are higher on a rally that began modestly in the pre-market but accelerated rapidly after the regular session opened, it is reasonable to wonder whether there is indeed a Pavlovian quality to the current market environment. That was his joke. He said, well, they rang the bell. And so investors started to salivate because they heard the bell ring. And that's been a function now of what's happened over the last 15 years is that we've applied a neutral stimulus. So the neutral stimulus is the interventions. And that was repeatedly paired with a reward stimulus of markets going higher. So this is the Pavlovian experiments, ringing the bell, giving investors a result. So investors have now been conditioned to expect that if there's a crisis of any type, that the Fed's going to step in and bail them out. So why not take risk? And that's really the definition of moral hazard. The actual definition, if you look up moral hazard, the lack of incentive to guard against risk when one is protected from its consequences, e.g. by insurance. And this is what investors now feel that they have.
Catch me daily on The Real Investment Show. The link is in the description.